Good morning, everybody. Happy to have you all join us. We'd like to thank all of you for attending. Our speakers today are going to be Jeremy and Megan, who will be talking about it from the accounting side and also from the tax side. Without further ado, Jeremy, it's all yours.
Sure. I want to thank you all for coming today. Like David just mentioned, this is a massive change that's going to impact everyone, but I will say to varying degrees. For some people, the debits and credits aren't going to change much, but it'll expand the disclosures. For other businesses and other industries, it's going to be a wholesale change across the board, debits, credits, disclosures, and so on. My name's Jeremy Dillard. I'm a partner in the Los Angeles office. I'm the technical partner for the audit practice. And when I'm not doing my day job, I'm in New York as one of 3 CPAs that actually advises the FASB on how to change GAAP for private companies. So I sit down with these standard setters, let them know feedback from companies like you as far as what works, what doesn't work, so they can understand if they need to further tweak the rules, or maybe it's just a gap in understanding they need to just offer more webcasts and so on. So getting right into it, agenda, going to cover the background on what's going on with 606. I'm going to walk you through, most of the presentation is going to be on that 5-step model, the second bullet point there. I'll touch on some other guidance that's changed in GAAP because of 606 being issued. We'll talk about transition, which will be one of those key areas that you're going to want to really focus in on, because there are 2 different ways that you can adopt 606, and the devil's in the details on both of them as far as what you need to know. I'll cover at a high level some of the new disclosure requirements that so you can understand. And simply put, think of what, if you're used to disclosure of your RevRec policy being maybe 1 paragraph or even as short as 1 sentence, I'm seeing across the board it's almost a full page. And for some companies that are in multiple industries, it's 2 to 3 pages, just for the policy. I'm not even talking about tables and footnotes and all of that. Then we'll talk about some resources that are available at the FASB, at the AICP. I'll briefly touch on that. So if you want to do some of your own homework and dig into some of these details on a little more granular level, you'll know where to go. And we'll cover with Megan the tax side of things, so you'll understand mostly what's going to happen on the GAAP side. But if you go, well, okay, crap, how does this impact my tax return and my tax bill? She's here to help walk you through at a high level so you can understand and bridge that gap. And then lastly, we're going to have breakout sessions. They'll go about 20 or 30 minutes where, like Kraj mentioned, it's going to be for certain specific industries. And again, it's just going to do a deeper dive into some of the more nuanced issues that are changing for each industry. So, first thing, what's been changing here? So, the gap that we're all used to is kind of this evolution of accounting rules that just kind of got baked into over the last 4 decades. And some of you may be aware, when you recognize revenue, totally would change based on your industry. For example, healthcare would recognize it different than software, different than banking, different than manufacturing, and so on. And as part of the process, the FASB, when they're looking at trying to go to one single standard, and moreover, converge it with international rules, so that if you're a manufacturer or a service provider here in California and you're booking revenues, you're playing by the same rules as maybe your competitors in a foreign country. So in the process, they basically scrapped all of the industry guidance. That's gone. Starting your calendar year 2019 financials, all your industry guidance, all the RevRec rules are off the table, and it's now these new set of rules. And some of it, honestly, was just stuff that it kind of wasn't even in GAAP. It just kind of creeped into industry guidance over years. An example might be contractors, where they have certain supplemental schedules that were in the financials. That was never required in GAAP, but industry standards had kind of started making that an expectation that users always wanted to see a lot of that supplementary info. Now, at a high level, the RevRec model is simply you're going to match revenue recognition with the transfer to the customer. That's it at a high level. Now, what they do is they have this 5-step model, and simply put, I'll bake the first 2 into the group of what. Steps 3 and 4 is how much, and step 5 is when. At a high level, that's the model. So let's get into the what with step 1. So first of all is, do you have a contract? Now, consider this the bouncer to the RevRec party. You know, it only applies if there's a contract. If not, you're completely out of 606. Now, right here, it shows on the bullet points, these are kind of the criteria. And let me pause for a sec. There's a lot of content on the slides. Don't be worried about trying to read everything. It's all in the handouts you have. what I'd like you to do is use the notepads and the pens at your table. Jot down notes, like the slide number, and if there's something you want to look into later. And just pay attention to what I'm saying and what Megan's saying. That's how you'll take away the most from this presentation. Now, these 5 criteria that you see up here, they put them in there because they're kind of important. You need to know kind of how much the contract's for. You know, if someone's accepted or not. You need to know all of this to go further down the 5-step model and figure out, okay, how much is my sale worth? When do I get paid? Is it collectible or not? So that's why you have to have all of those criteria in your contracts. Now, like it says in the bottom bullet point, it does not need to be in writing. It can be verbal. The FASB was in no way trying to say that a contract only applies if you have it in writing. If I have a restaurant and I sell a meal to a patron at my restaurant and they eat it, I don't need to have it in writing to know that it's collectible, that they are obligated to pay me for it. That's an example of where it doesn't have to be in writing. But you do need to have enforceable rights. And the guidance gets into a little bit of detail, but just want to clarify this. With enforceable rights, they'll say it's a matter of law and legal opinion. They are in no means trying to say go out and get a legal opinion from a law firm. What they're expecting is you know your business better than probably anyone else in the room. You're going to know when you've earned the money and when you're entitled to collect, or when your customer is obligated to pay. That's what they're talking about. But they also understand there are outlier situations where it might make sense, if you're not sure whether you're entitled to payment or not, where you would talk to an attorney. I will say though, with enforceable rights, when you start talking about contractors and change orders, that's one area where I would say, and even the FASB would say, it's probably, you're going to want that in writing. It's kind of hard to go back in if you're a contractor after the fact and say you deserve more money and you never got it signed off by the customer. So first example we have is working through enforceable rights. So supplier enters into a 5-year master supply agreement. So the supplier is obligated to produce and sell parts for a particular product the customer that's manufactured as the customer requests it in POs. Customer is not obligated to purchase anything. However, it's highly likely that they're going to purchase parts, and it's not practical to get the parts from another supplier. So the first question is, what enforceable rights are in this contract? Well, to summarize, the company's not obligated to make anything, right? The customer is not obligated to sign anything. This is an MSA, this is master supply agreement. The PO is where the contract starts coming in. The MSA might just have your master supply agreement, might have the overall terms, and the POs will just refer to that MSA. But once the POs are issued, that's when the contract becomes enforceable. So until then, there's no contract. Now, next thing is also talking about contract duration. What's the term of this contract? How many months or years do you need to consider in this? And do you need to talk about renewal terms and so on? As it relates to termination clauses, if you can exit without any penalty, then you probably don't have a contract yet. Because both sides can walk away. Nothing's happened that obligates either side to this. So the example here that's in the bottom part of this slide, I have, in the first example, I have a 1-year contract, but you're committed for year 1, but not for years 2 and 3. So it's a 1-year contract, right? Now with the 3-year deal, you're committed for 3 years, but there's no penalty after year 1. So for GAAP purposes in 606, they would almost consider this a 1-year contract again, when you're trying to figure out your contract durations. Now you might say, I'm in the type of industry where I'll have multiple agreements that all work together. Do I have to go through the pain and the hassle of trying to analyze each of these separately? Can I combine them? How do I handle this? And right up there is the guidance. That'll talk about basically, did you negotiate them in a package? Okay, maybe that's more appropriate to combine them together. If the price in the first deal is contingent on the price in the second deal being completed, that's another example. So an example might be, just putting this into practicality, if I have a design and construction firm and I have one contract that covers designing a building and a second one that covers construction, but they're both negotiated together, you could bundle those together and treat them as one contract under 606. Hopefully that's making sense as far as when it's appropriate. And again, everything in 606 will pretty much say use judgment. There is no black and white rules as far as here's the exact scenario where you have to go one direction or the other. Contract modifications. So this is, I have the order from the customer, I'm in the middle of fulfilling the order, and something changes. Maybe the price changes, maybe the order size changes. I go from providing 10 units to providing 200 units, whatever it is, but you're changing the terms of the deal. Well, there, again, use judgment and understand, am I changing in a way that's proportional to the original deal? So for example, if I have a contract to sell 10 lawnmowers, and I've already delivered 5 of those lawnmowers, now the customer calls me up and says, I love your product, I want to buy some leaf blowers at $1,000 each, and that's the standard listing price that I sell those at. Well, if all they want to do is buy those at the standard price, I've got a whole separate contract. So I have the original one for the lawnmowers, and now I have a second one for leaf blowers. Now, if they go, you know what, hey, I want to buy this one, the customer says, I'm throwing so much business at you, I kind of want a bulk rate, give me a discount. Well then, I don't have a separate contract, I've now modified the original one. I've expanded the scope to sell more stuff, but I changed the price for everything across the board. I apply that discount to everything, including the items that have already been delivered. So there's, again, when you're starting to talk about contract changes, this is an area where you're going to want to dig in if this is applicable to your company and understand what's going on. So we're still in the what. Now we're identifying performance obligations. And this is that unit of account. This is where the accountants roll up their sleeves and start figuring out, okay, the debits and the credits, and where do I need to start analyzing this in an Excel spreadsheet. I'll give you a second to read what's up there on the screen. This all comes down to figuring out if it's a distinct good or service. That's the concept here you need to take away with performance obligations. It's got to be distinct. Because the next step is we're going to figure out what the contract amount is, and then ultimately we're going to allocate it to each of these performance obligations. So you got to be really clear. Now, what you do though is, for it to be distinct, you have these two issues, and they both have to be there. One is customers got to be able to benefit from it, and second is it's got to be separately identifiable. So benefit from it. Everyone in this room probably has a cell phone, and we all remember those annoying days where you get this cell phone and they wanted to charge you a $100 activation fee. I never benefited from that activation fee. Never heard of anyone benefiting from it. So that'd be an example where it doesn't meet the first criteria. It's not saying, and I'll explain how this comes into play later, but just understand, you got to benefit from it. Now, separately identifiable. Issue here is, okay, you're breaking it all down, separate. Whether you can benefit or not, think of that as the floor in this whole concept. I'm breaking it down to what can I benefit from? If customer can't benefit, it's not a performance obligation. But if they do benefit, now is it separately called out? Can I separately identify it in the contract or not? If I can, okay, it's met both of those criteria, it's probably a performance obligation. So as you're going through and trying to analyze this, then here are some practical tips for you to consider. Think about at the high level, what's the company promising? With the example I laid out of getting a cell phone, the company's promising two things. I'm going to sell you a cell phone, piece of equipment, and I'm going to provide a service. Those are the two performance obligations. Regardless of however they nickel and dime the fees throughout the whole contract, that's basically what the customer is viewing from it. Same thing if you're a manufacturer. If you would charge a fee for creating a mold, and you keep the mold, it's not, the customer never gets the mold. That's an example of a setup fee. Customer doesn't benefit from the mold being created at all. So whatever revenues, that gets allocated to the other performance obligations, because this isn't, the setup fees aren't. Now, one thing to keep in mind is they don't have to be specifically called out in the contract if they are part of your customary business activities. Think of, if we've all seen on the freeways, the loaner vehicles that are from dealerships, right? Someone has their car getting fixed at whatever dealership, and they're driving a loaner for the day or for a couple days. That's not part of the sale agreement, right? If it, I don't care, BMW, doesn't put in the contract when you buy the car, hey, we give you a free loaner whenever you come to our dealerships for service, but it's implied. So when the auto manufacturers are having to go through this, they had to figure out, okay, that's an implied performance obligation that we will give them for free a loaner whenever they're coming to use us for that, the warranty period of 3 or 4 years. That's an example of an implied performance obligation, and they actually have to start setting aside some of the money from when a car is sold for the revenue that's earned when they provide those services, those implied services. All right, next example. So enters in a contract to sell a piece of equipment and installation services. The equipment's operational without any customization or modification, and the installation is not terribly complex, and there's plenty of other vendors that are out there that can do the install. So let's take the two criteria. First one, can they benefit from the good or service? Yeah, the piece of equipment, they can sell it right away. They can benefit from that piece. The service, yes, they can benefit from that. And they're both separately identifiable. And if you think about it, any other vendor can come in and do it. So it's not so highly integrated between the installation or customization of the equipment to get it at the customer's site that it's really one performance obligation. The customer can use it as is, sold there, and they can have someone else do the install. So in this case, they have two performance obligations. Here's another example to contrast to the last one. So a contractor gets a deal to build a hospital. Now, they're responsible for overall general management of the project, as well as certain specific services and goods, such as engineering, site clearance, foundation, procurement, construction, piping, wiring, and install of equipment and finishing. Now, the contractor can, and often does, sell these things a la carte whenever other customers ask him for it. And the customer could generate economic benefit from the individual goods or services. So, is there a single or multiple performance obligations is what this contractor has to analyze. So yeah, they can benefit, like you see in the first column, from all these different items that are bundled into the contract. However, think of the issue of control, and what's the customer paying for? From the customer's perspective, they're paying for a hospital. They don't care about all of this and all these different performance obligations, and moreover, just because it's so heavily customized, these are highly integrated activities to do all of these things. And because it's all in the contractor's judgment, they're so highly integrated that it's viewed as one performance obligation, building the whole hospital. So you say, okay, great, but that sounds good, Jeremy, but I'm a service provider. You're telling me, and I've got a contract to do a daily service, say janitorial at an office building. You're telling me, and every night, my crew goes in and cleans the building. You're telling me that I have 365 different performance obligations? And I have to go through my accounting system and that level of headache to try and handle this? And the FASB said, no, we'll apply some common sense to this theory. So they came up with this concept, and it doesn't exist in current GAAP. It's new with 606, called a series provision, which basically says if everything is handled consistently throughout the entire term, and same method would be used to manage it all, and they're all relatively the same, every day is the same, then you could almost view it as percentage complete. As you're completing the progress, that percentage can be recognized as revenue. And you could skip right over that allocation guidance to each daily activity and move straight on towards that measurement of progress. So this one, I will say you need to, after hearing this, go back to your sales reps and talk to them. Because this is where a lot of companies are getting into, they're tripping into problems because the sales reps start promising things. And it just, whatever it takes to incentivize the customer to sign the deal. So the sales rep might go, we're going to give you extra long warranty. We're going to give you a discount on your next purchase. We're going to do this or that. The more you can contain these things and standardize them, and you'll figure out real quick, the easier your life's going to be. So this concept of material rights. So with customers, sometimes what a sales rep will do will say, you know what, I'll give you something extra so that you will decide to enter into this sales commitment, into this purchase. Now, if it's important to the customer, then chances are it's a material right, because it's material to the customer. Again, a lot of the standards driven based on the customer's perspective. And this is a significant change from GAAP. So we'll go to example 4 here. Retailer sells some goods to a customer for $100. And what they do is they say, okay, well, you know what, to get you to do this, we'll give you a coupon for 40% off. But at the same time, you know what? We've already got it published out there in the local newspaper that we have a 10% coupon. And you can't double dip. You only get one or the other. And you only get the 40% if you buy into this deal now. So this is a concept of material rights. You know, is the 40% a material right? What do I do about the difference between the two? So here's the analysis that you would go through. First, does it include options? Yeah, it does. Option to buy additional 40%. There, buy goods with a 40% coupon. Did it provide it to the customer? Yeah. The customer only got that 40% discount if they actually entered into the sale. And it is incremental to what's typically given. It's not just some standard promotion that if someone knew the secret discount code or promo code on a website, it would work. This is, they only got because they bought it. And again, like I said down here, you gotta use judgment. Is it material? Is it important to the customer? If it is, then it becomes a second performance obligation, and you would have to account for it separately. Now, where you see this most come into play, and all of us do, is loyalty programs. So think of airline miles, hotel points, dining points. I know Starbucks, I'm a big fan of those, and I have this whole section on my smartphone that is just like 20 different loyalty programs. I try and maximize those things. Well, they have to go through and figure out how to handle this. Now, current GAAP has two different ways to handling loyalty programs. Kind of funny, that happened when we were talking about hotel points. All right, so GAAP currently says two different ways. One, I buy a ticket to an airline, I buy an airline ticket and I get the points. The airline books the entire revenue now, once they sold the ticket, and then whatever the points are, they just book a liability, separate from the revenue side, for whatever the value is of those points. Because they're gonna have to honor those at some point in the future. Other method, and this is so incremental cost method, that's current GAAP, that's going away. Current GAAP also allowed revenue deferral method. This is the only one that's gonna be allowed going forward under 606, which says, okay, you need to figure out what's the value of those points and carve that out from my transaction. So if I bought an airline ticket for $300 and the value of the points is 20 bucks, then the airline can book the revenue for $280 and they have to keep the $20, the value of those points, parked as deferred revenue until I cash in the points for a free airline ticket. Because I basically, that's my material right. I have a right to a free airline ticket at some point, and there's a value to that. Now, practical tip I'll tell you is if you have any kind of loyalty programs, put an expiration date on them. Make your life really easy. And if you could, in a perfect world, your expiration date is your balance sheet date. Now I know that doesn't always work from a practicality standpoint, but if it did, then you don't have to worry about this at all when it comes to your year-end numbers, right? Because everything's expired. All your points are expired every year. So that is step 2. Step 3 now, transaction price and trying to determine it. This is where you're going to also have a lot of challenges. So I'll give you a second to read the objective that's up on the screen. All right, transaction price. What you want to be aware of does not include amounts that go to third parties, like sales taxes, or all those similar amounts. But when you're going through trying to figure out the entire transaction price, these are each of the categories you have to consider. It's not necessarily just the stated amount of I sell a piece of equipment for $10,000. The variable consideration, okay, well, do I have product returns? And I'll cover a lot of these in a little more detail. You know, do I have other issues? Do I have sales discounts? Do I have a right of return with the customer? As well as those customary business practices, like I talked about with the case of the loaner car. That's another performance obligation that they would have to consider. That would be, in this case, non-cash. And you have to look at all of these and figure out, assume the goods or services, though, will be transferred as it's stated in the existing contract, and the contract's not going to be canceled, renewed, or modified. So when you're trying to figure out transaction price, you can't go, well, I know there's all these performance obligations, but this is the one that customers getting into it for. All this other crap they don't care about, and most likely they're never going to use these. You have to assume the contract's going to be fulfilled as it's stated, as it's written up. So the hardest one is variable consideration. All right, if any of these terms sound familiar, they are variable consideration. You're going to learn a lot about it. Discounts, rebates, refunds, credits, price concessions, incentives, performance bonuses, penalties, and rights of return. So, another way to think about it is, are they based on a future event? Variable consideration, a lot of times, when you get into the deal, you know some amounts, but maybe there's issues, all these kinds of items I brought up, where they're contingent on something happening in the future. You know, okay, product sold with a right of return, or a performance bonus on achieving certain milestones. Those are examples of variable consideration. And 606 gives you two different methods for estimating it. One is the expected value method. That is, I've got a whole range of possibilities. I sell something, but I know that I'm going to have sales returns, for example. Well, that's a whole range. I could get 1% return rate, or I can get 20% return rate. But it's a whole range. That's where you use an expected value method. Most likely method is usually when it's one of two outcomes. Think of a performance bonus. Either I hit it or I don't. That's expected value method. Then the important thing is there's this concept of a constraint that's down here at the bottom, which says, yeah, we know it's uncertain. The ultimate amount that you're going to receive under this contract for all the variable consideration, you can recognize it up to the extent that you're damn sure it's not going to be reversed later. It's that simple. So highly probable is usually what the standard's using. So figure 90% confident that you are going to get it, then you can include it in the variable consideration. That doesn't mean you get to recognize it now. It just means it goes into the math now. It's not something that gets parked off balance sheet until later when the contingency is resolved. So when you're going through trying to figure this out, and you're trying to understand when you can book it, when you can't. First one, things that are highly susceptible to factors outside of the company's control. Think of market volatility, third-party action. Third party could be the customer, the sales returns. Weather conditions, there's all these different things that can come into play. Or third one down, your experience is limited. We just don't have enough history to even know what rate of return we're going to get on these products because they're a brand new product for our business. Okay, so in that case, you might just go, we're going to hold off on this. So next example. And we've got two examples here to kind of highlight the variable consideration. All right, we have a company. The company sells a piece of machinery, and we also sell a consulting service. And the consulting service is to help improve my customer's manufacturing process. Equipment and the consulting service are separate performance obligations. Stated price for the equipment is fixed, it's $10 million. My consulting service, though, is contingent on the customer having a 5% improvement in their performance. If they do, I get an extra $50,000. So you want to think through, how would you determine the transaction price? Is it 10 million? Is it 10 million, 50,000? Also in developing variable consideration, what things you would work through when you're asking that. So first, which method's most appropriate? Am I going to use the most expected value or most likely? In this case, it's a performance bonus. It's either all or nothing, so you're probably going to go with the most likely method. Next is, okay, what's the likelihood of actually earning this? Do we have this back history of knowing that it's an extra 50,000, just guaranteed. We're going to get it. We always have more than 5% improvement in the performance when we roll out this piece of machinery and we provide the service. It's always 20% improvement. So we got the 50,000 in the bag. That's ours. Okay, well, you're highly probable you're going to get it. You can include it up front as far as part of your calculation versus, you know what, we've always sold the machinery, but this is the first time we're doing the consulting service for kind of those process improvements. And we think it's going to be there, but we're not 100% sure. So in that case, the 50,000 just kind of gets parked until you are confident you are going to get it. And then that gets into that significant reversal of the revenue. How confident are you it's going to be backed out? And that'll ultimately get you back to what's your transaction price when you're at contract inception. All right, this one, there's a lot of math in this one. I'm warning you now. So take a breath. All right. I call this the vacuum sales, the vacuum example. And this one's right out of the standard. Okay. I'm the door-to-door vacuum salesman they used to see in the Leave It to Beaver commercials, right? Now, I go door to door and I sell 100 vacuums, and the vacuums are $100 each. So total contracts, across all 100 contracts I've got is $10,000. All right, control transfers to the customer when I actually deliver the vacuum, so when I sell it right there, even though it's not in our contracts, we have this kind of understanding. We tell this when we're selling it door to door. You know, you're not happy in the first month, you've got it, you can return it to us. And our cost for each vacuum is $60. So you go, okay, do I have variable consideration or not? This example, you do. Because you've got that right of return that you've implied. It's not in the deal, it's not in writing, but you told them they can in the first month. So you have to go through and you say, okay, well, variable consideration, it's not an all or nothing. It's a whole range as far as the number of vacuums, so I'm in the expected value method. So what I end up doing is I go through and I say, okay, historically, we have about 3% return rate on these vacuums. So I received the $10,000 up front. So debit cash, 10 grand. But I know only 97 of those 100 vacuums are probably ultimately going to be sold. So, and the other 3, most likely, I'm not confident I'm going to keep the sale. There's a chance those are going to be returned. So I'm going to credit revenue for $9,700. And I've got that refund liability for $300. And this is on day 1. This isn't later, this is all day 1. So that's the sales side of it. But I'm a manufacturer, I've got the inventory issue to deal with. So now I go to the cost of sales side. I've got 97 that I'm confident are going out the door, and I'm never gonna see those things again at $60 each. So that's the $5,820. All right? I have 3 that are coming back to me. So it's not quite a receivable yet, but I'm pretty sure they're coming back to me, so I have an asset on the books for the 180. But I had 100 go out of my warehouse at $60 each. That was my cost, so inventory goes off the books for $6 grand. So you can see is for manufacturers, this gets to be a lot more of a headache trying to deal with variable consideration. Now sometimes, and this is more in the service provider arena, you'll see out-of-pocket expenses. Think of your law firm that says, okay, you know what, those invoices that have, you know, that we made 20 photocopies and we sent this number of faxes to you and all this other little, you know, nickel and dime charges. Well, those are all variable. I don't know how much I'm going to have up front when I do legal services, when I land this case. You're telling me I have to estimate this crap up front? No. So this is already in GAAP. It was in the EITF 0114, and it was this concept of principal versus agent. And it carried over into 606. What they did is they created this shortcut. They call it the as invoice shortcut. And bear with me while I read this off. I want to get the language exactly right. It says, if a company has a right to payment from a customer for an amount that corresponds directly with the value to the customer of the company's performance completed to date, it may recognize revenue in the amount to which it has a right to invoice. So, if I'm a law firm and I'm billing you for hours and I incur all these ancillary costs, and my contract with you says I can bill you these things, it doesn't say I have to wait until the end of the case's settlement, I can bill you now, I can bill you now, I can handle all these out-of-pocket costs at that point, is when they can be booked as revenue. You don't have to go through some crazy analysis to figure out those kinds of issues up front. So now you know the contract amount. You know you got a contract, you figured out the performance obligations, now you figure out the total contract amount. Now step 4 is, okay, great. Allocate the contract amount to the performance obligations. I'll give you a second to read the objective. And the way you do this is you look at the performance obligations and you say, what's the right amount for each performance obligation? And the starting point is, what's my standalone selling price? So in a perfect world, all my performance obligations, I sell them all individually a la carte. Then I go, what's my standalone selling price? Now that doesn't always work. There's sometimes where things are just done, they're baked in there, but it's never explicitly stated as a separate price. And on the next slide, what you'll see is there's 4 different kind of hierarchies that they have here. So first, observable price. That's what your company lists it for. Second is, well, say you sell a piece of equipment or sell a good and you also provide installation. Well, you never charge separately for installation. Others do though. And using that example from earlier, it's a separate performance obligation, it's install. So you go, okay, great. The observable price, I know what it is for the equipment. I can go to maybe what an installation service provider would charge. That's that second bucket. Now if you go, well, I've got a performance obligation and you know what, I can't find any observable market price from anybody who does this. Then you go to the third bucket that says, great, what would it cost plus what's my typical margin? And you work your way into that. And then lastly is the default bucket of whatever's left. Now, what this table at the bottom, and this is on, again, in your handouts, is trying to highlight is once you figure out what your sales price is, your standalone selling price for each of these three goods, then in this case it's 150, but my transaction price might be 100. That bundled these three things together. Well, I have to use the relative value of each and kind of do the math to work into what each of these should be. Now, if you're in the software industry, there was this concept of vendor-specific objective evidence. VSO was the short name for it. That concept's gone. VSO is actually harder than this. So they took it out and said that software companies don't have to be penalized trying to do that anymore. So you go, okay, great. Now, I got it. I have performance obligations. I have a contract amount. I allocate it. But what if one of my performance obligations is variable? It's not me. All right, so then you go, okay, do I allocate the variable consideration to anything particular? Or do I just allocate it across the board? And you can allocate it to specific performance obligations if both of those lower criteria are met. So some examples, say a contract includes selling a machine, installing it, and providing an extended warranty. So normally, I would say 3 performance obligations, but in this case, customer can't do anything. They don't have control of the machine until it's set up and installed. So I'm treating selling the machine and installation together. I'm bundling those into a single performance obligation. That's what I've done. Now the warranty is a second performance obligation. Now, variable consideration might be, I have a performance bonus. If I get early install, yeah, we're fine. If I have early installation of the machine and it's up and running before it's scheduled to be, I get a performance bonus. Well, in that case, I would allocate that variable consideration of the performance bonus just to that performance obligation of selling the machine and installation. I wouldn't have to spread it out across some of that bonus to the warranty part. So next up is step 5, which is all right, I now know what I'm doing, I know how much. Great, when can I take the credit to revenue? When can I book this thing? And it's basically as you satisfy each performance obligation, that's when you get to recognize it. And they gave you a 2-step process to do this. You start with that first box that says overtime, and then it's point in time. And I'll explain these both. But real quick, if you don't satisfy overtime and you go to point in time, and they say, fine, point in time, that's when control transfers to the customer. You know, there's some things you may want to think about because there's no bright line on when point in time happens. It's totally a judgment call. Some examples could be, when do you have a right for payment? Another could be, when does legal title transfer on the asset? Another one could be, when does physical possession of the asset transfer to the customer? Another one could be, who's got risk and reward ownership of the asset? Risk and reward of ownership. And last is, has the customer accepted it? If there's acceptance criteria that are required. All of those will help drive you towards when is the correct point in time to recognize the revenue. Now, like I said, first step is overtime. So this is, if you meet any of those 3 bullet points, you get to overtime. The first one's more in the service arena. Think of it as, I use freight as this example. I am shipping a container from Los Angeles to New York. Now the customer is simultaneously consuming and receiving the benefit as I move it across the country. And moreover, say I stop in Chicago, they can tell me to stop right now, and they're going to have a different carrier pick up the container and take it the rest of the way to New York. And I'd have right to payment for it. That's an example of simultaneously consuming and receiving benefit. Another example might also be, think of that janitorial services. They're simultaneously consuming and receiving the benefit. The middle bullet, that's more of your contractor. Asset that's in the customer's control that you're either creating or enhancing. Asset is land, you're enhancing it, you're building something on it. It's percentage complete, you're in overtime as far as the revenue recognition. Third one here, that's more of your custom manufacturing, contract manufacturing, and so on. And on the next slide, we have an example for that. So bear with me, I'll read it off. Company's contract with the customer. It's going to provide 1,000 units per month for 2 years. So service is going to be provided evenly. We're just going to keep cranking them out. And we're going to, all the units produced under the arrangement are substantially the same, and they are highly customized for what the customer wants. And assume that the service of producing each unit is a distinct service. And they have a right to payment for anything that's been produced in case the order gets canceled. So you go, okay, is this overtime or a point in time? Now this would be overtime, if you think about the rules, because the goods are highly customized, they have no alternate use, and the company has a right to payment for what they've produced to date. Now this is a change from current GAAP for the manufacturers. And current GAAP would say normally you're booking revenue when you ship the thing out. That's not how this is going to happen. In this case, it's going to be overtime. Now, if you also are a manufacturer where you're used to just-in-time inventory management systems, this is going to be even further complicated as far as trying to figure out when you're booking revenue. So you go, okay, great. I figured out that I'm in the overtime bucket. So I now need to figure out, okay, how do I recognize revenue over the contract duration, over time? What's the measure of progress? And the answer is it's going to depend a lot on your judgment as far as which more faithfully represents the measure of progress. Is it from the, right here it says output and input method. I would say from output, think of it from the customer's perspective. Input, think of it from the company's perspective. Output, okay, direct measurements of the value to the customer. So your contractors, a lot of times, are going to be down here because they measure percentage complete based on the costs incurred to date over the total expected costs on the contract. Now again, we get back to the as invoiced practical expedient. Again, this is going to be overtime, and I've got an example here on this. So I'm a power company, and I enter into a contract with a local manufacturing plant. They are worried about volatility on their power, so what they do is they enter into a deal for 6 years with specified rates, and these are at the contract inception based on the forward yield curves of what we were expecting to have for the power rates. So you get a $50 per megawatt hour for the first 2 years, then 55, and then 60. And that's what that was market pricing at the time we got into the deal. And it's one performance obligation. We provide power, dedicated power just to that manufacturing plant. So in this case, their life's pretty easy. What they do is they go, okay, what's the amount of power that was delivered or consumed during that year or during that period? What was my billing rate? Doesn't matter what the market rate is. They go based on the contract. So even if the market rate triples, they still stick to what the contract says. That's the revenue they get to book. Next up, for mostly manufacturers and distributors, there was this concept called bill and hold. And it was never in GAAP. It was SEC guidance. So what they've done is they've now dropped this into GAAP as part of 606. And I've underlined there some of the more key things you need to know, but you have to meet all these criteria in order to get it. Bill and hold is simply, think of it as, I'm a manufacturer, David buys from me some parts, but he goes, you know what, I'm in the middle of moving my office, so can you just not ship it to me right now? This is the absolute worst time ever, but I want to buy it. Can you hold it for 2 months until I get the relocation done? And then we'll have it shipped out. Well, that's a bill and hold, and in order to qualify for revenue recognition, I have to meet all of these criteria. It's got to have a real reason to be done. It can't just be done to manipulate the revenues or expenses or whatever. So in this case, yeah, it's because he couldn't take possession of it. It's such a burden for him because of the relocation. Okay, goods are identified. Yep, I've carved them out. They're on a pallet. They're sitting there shrink wrapped on my somewhere in my warehouse, just waiting until he says, okay, send it to me now. That gets to the third one. Are they ready for physical shipment? And fourth is, I cannot have the ability to redirect it. I can't have someone else come in and say, you know what, I need those goods too. I can't go, well, all right, fine, you take this pallet, I'll create another pallet, shrink wrap it, and hopefully I'll have it ready for when David tells me. I gotta have, he'd say, this is his property. You know, if the whole warehouse burns to the ground, he's filing the insurance claim, not me. It's his loss. He bears the risk of ownership. All right, other guidance. So there's some other areas that also got tweaked in GAAP when they rolled out 606. Contract costs are two basic buckets. You have the cost for obtaining a contract and the cost for fulfilling a contract. Cost for obtaining the contract, current GAAP says you can take a policy election of just capitalizing those and burning them off over whatever the contract period is, or you could just expense them outright. New GAAP 606 is you have to capitalize them. And when you burn them off the balance sheet, you're going to take them off over whatever the expected contract term is. This is where renewals come in. For software companies, this is a nightmare. So if I am Salesforce and I find a new company that wants to buy a license to Salesforce and it's good for the first 3 years, but then there's renewal provisions, and I pay this huge commission to whoever got that contract, I don't just do it over the initial 3 years. If I know it's likely they're going to continue renewing, I have to go over what's the expected term, including renewals. So software companies, this is becoming a big challenge, trying to figure out what's that appropriate amortization period. So this, I want to kind of pump the brakes a little bit on 606 and tell you that there is a little bit of silver lining here. What they did, little, I'm not going to say there's a lot. What they also did is they said, look, this only applies if it's your ordinary operating activities. So if you have a piece of equipment that you're in the business of selling widgets, but you have an old piece of manufacturing equipment that you haven't used in a while and you're just getting rid of it. That does not qualify under 606. You are not in the business of selling the pieces of equipment. You're in the business of selling the inventory items. So you wouldn't fall into 606, you'd fall into this other area, 61020, sale of non-financial assets. Same thing, if you owned real estate, you had a corporate office and you decided to sell the corporate office, chances are that's not your business model, is selling corporate offices. Your business model is something else. This just happened to be a large transaction. This is where you're going to go to for guidance. It's going to follow some similar concepts here, but not nearly as painful as 606 with all the variable consideration and things like that. Okay, so talked about the model. We talked about how to handle some contract costs. Now you have transition. There are two different ways to handle transition, and what we're talking about is, I'll say a typical company. In this example, they've got a company that has 3 years presented in their financial statements. I understand, obviously, most privates have 2. For this, it's 3, just for example purposes. And it'll make sense in a minute. So, first method is that top row, and it's full retrospective, which simply means when you adopt 606, you go back and recast all years that are presented in your financial statements. Typically, if things start and end during the year, that's not a problem. The revenue is fully booked, fully earned, it's done and put to bed before you get to the year-end balance sheet. It does become a little harder when you're talking about stuff that straddles year-end, right? Because you'll be halfway through. You don't know when the revenue should have been booked, especially if you're talking about point in time or overtime. It can be a little bit harder to analyze, much less you're going back multiple year-ends to try and analyze it. So you go, that's a pain in the butt. I'm not going to do that. Let me go to the shortcut here, which says, you know what? They call this modified retrospective, which is my prior years stay fixed. I don't touch them. I only adopt 606 in the current year, so in calendar year 2019. Sounds great, but there's a lot more to it. And I'll walk through each of these in more examples. Now, when you do this, what you have to be aware of, if you go with this second shortcut where it says, I don't touch prior years, I only touch the current year, is you're going to have some required disclosures. One is for all the line items in your financials that would be impacted by 606, you're going to have to show old GAAP and new GAAP in the footnotes. So it's almost like keeping a double set of books. So that if someone looks at it and goes, well, I see you had revenue of X and Y in 17 and 18. What would it look like under the old rules in 19? So I can, apples to apples, I can understand it all. And yeah, we get that you're now using a new method, but for comparability purposes, during this year of transition, we want to be able to see in the footnotes how this works. How comparable are these numbers? You can't just say, hey, I have old numbers, and here's new numbers, and I'm not going to tell you how comparable these are. They're forcing you to do it. And if there are any significant differences between what the new numbers would be and the way the old numbers, they would have been calculated under the old rules, you have to provide some explanations why. So this will kind of hit home this transition and how the debits and credits start to flow through. So I'm a company, I sell software licenses. Under old GAAP, I recognize revenue straight line over the contract period. Under new GAAP, I'm going to recognize it at a point in time when customer gets control. And for purposes of this example, think of it as software that I don't have to have any continuing involvement. I just give you the license, it is good to go. Now, moving on, customer pays me 100 grand up front. The contract's 100,000, they pay me, 20,000 a year, contract's 5 years. And the start date of the contract where I gave them the license was the beginning of 17. So, as you'll see on the next slide, old GAAP would say, great, 17, I recognize this straight line, and I get 20K a year. Very, very easy. Revenue of 20,000, boom, 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 each year, 17, 18, 19. New GAAP, again, now I have two different transition methods. Let me go with modified retrospective, which says I'm only touching the current year. Right? I don't get to go back into prior years, but think through this example. I gave control to the customer in 2017. That's when all the revenue should have been booked under the new rules. So I'm not touching those two, but the remaining 60,000, so those two were there, the remaining 60,000 goes directly to retained earnings. I never get credit for it in sales. Let me repeat that. This is the problem with modify, you got to be aware. It just evaporates and goes directly to equity because it was earned in the prior years. You're not restating the prior years, so you never get to reflect it in revenues. That's a big one to be aware of, depending on the types of contracts and the type of revenue recognition that you're doing. Full retrospective, okay, I'm going back and recasting prior years, so now I get to take credit for all 100,000 in the year when control transferred to the customer. I book a corresponding contract asset, that's just a receivable, for the 80K. And then every year as they pay my 20,000, it whittles down to that remaining balance that they owe under the contract. In the year of transition, the year of adoption, all of this has to be disclosed. It's not quite as simple as flipping a switch going, okay, great, new rules, boom, they take effect January 1 and I move on. You have to have some additional footnotes. They did provide some shortcuts here. Best thing to be aware of, and I'm not going to go through this in detail, you have it in your handouts, is for full retrospective, they gave you 3 shortcuts. If you go modified, they only gave you 1. And they're different. It's not the same across the board for those. So, let's talk about disclosures. We've talked about most of the meat of this new standard. All right, like I said, your disclosures, public companies I'm seeing tripling the amount of disclosures they have on this stuff. So figure there's going to be a lot of work to do here. So with your contracts with customers, you're going to have to present information so that a user understands the nature, timing, and uncertainty of revenue and cash flows. Let me read that again. Just think and let it sink in what you need to have in your footnotes. It's no longer, oh, I recognize revenue when it's earned, or when title transfers, and that standard like 1 or 2 sentence. All right? The requirement is that users to understand the nature, timing, and uncertainty of revenue and cash flows arising from contracts with customers. So that's going to be a lot. That's why you're seeing they're tripling it. And moreover, the second part here, disaggregating revenues. If you have both, depending on what you do, you may have both. where you're going to have revenue that's recognized over time versus point in time, you're now adding a table to your footnotes. So someone can go, great, you have 10 million in revenue. I know you provide some revenue based on services over time, and I know you get some revenue based on selling stuff, but I only see 10 million. You have to now have a table that breaks out the two. You don't have to provide, like, here's the 20 different revenue streams, but you can distill it down into what is the amount of revenue during the year recognized over time versus using the point in time method. Let's see, what else? Performance obligations. That was your general disclosures about rev rec with customers. Now we're talking about performance obligations. So probably these two boxes on the left are the ones I'm going to talk about the most. When do you recognize revenue? When does control transfer? Is it when it leaves your shipping dock? Is it when it's received by the customer, when they accept it? If you're a service provider, is it when you provide the services as you provide them, or is it when you are completed providing all services? That will have to be disclosed. Basically, when are you earning it? At what point is your judgment call? If you have bill and hold, you have some additional items you have to disclose. Significant payment terms. This is where you're going to start talking about things like variable consideration and any constraints you have. So you go, yeah, we have some contingent revenue that's out there, but we're not recognizing it, and here's the reason why we're not. Here's the constraints on it that explains why we're not recognizing it. Judgment calls. Again, this gets into everything too. There's no, like I said, there's very little black and white in these new rules. So anytime you're making a judgment call of saying, well, I sold a piece of machinery and I also provided installation services and an extended warranty, but you know what, control doesn't transfer until I actually set up and install the machinery, so I'm going to bundle together the sale and installation. That's a judgment call. That'd just be a sentence or two. So you're starting to see how you get to a full page just on the rev rec policies. And one thing I would say is, we're all of us aware that business changes over time. This is one of those footnotes where, as much as we're used to, like your accounting policy footnote, once everyone drafts it and blesses it by the board or by the owners, it's kind of never touched again. It's just always there in your financials. This is one where you're going to probably revisit every year. As your business model changes, as your selling terms change, all of those things happen, that's going to impact this footnote, disclosure of your accounting policy. Now, if I was trying to do overtime and I'm using a method, I'm going to have to talk about, okay, well, did I use it from the output method, which is kind of from the customer's point of view, or did I use the input method, from internally from our company's point of view, and how do we determine our measurement of progress? And why is that the most appropriate, or I think the term is faithfully representational method of recognizing revenue and the measurement of progress?
The room next door. They'll play with the lights.
Okay. As far as line items on the balance sheet, you'll see new terms in 606. Don't get too hung up on the terms as much. Contract asset could be like your prepaid commissions, things like that. You can still call it prepaid commissions. There's nothing wrong with that. Just the standard is going to use that as kind of a catch-all. Same thing on contract liability. That could be deferred revenue. Those terms are still perfectly fine to use. They're just trying to use it for the standard setting purpose so that they didn't have to try and define everything that could be a contract liability. As far as resources go, I would say, first of all, reach out to us here at SingerLewak if you have questions. The engagement managers, the partners, we're all here. We're all very knowledgeable in 606, and we can do our best to answer questions. What I find works really well is everyone's time is valuable. Tee it up. Have the questions emailed off in advance saying, hey, I need help understanding some issues on variable consideration, and here's the specific issues. It'll expedite the meeting and make everyone, that way we can do the research in advance and be prepared to discuss it with you. Whereas if we go in there with a good knowledge, but not so far into the weeds that we know every word of the standard, then it almost requires a follow-up meeting once we hear what questions you have. But if you need it as well, There is technical hotlines. The AICPA has one. The FASB has one. I will tell you the FASB one, they're great. I know the people that are on it. They wrote this standard, but they can only answer questions that you have in trying to understand the standard. If you say, well, my business is doing this, how does the standard help me? They will stop you right there and say, we can't provide that kind of information. We can just tell you how to understand the standard. We can't tell you, in your scenario, here's exactly how you should be booking it. If you want that kind of help, AICPA can do it, or we can do it. AICPA is on the East Coast, we're here on the West Coast. We're a lot more easy to get a hold of. If you go to the FASB website, just a couple things you'll see down here. They'll have it on their homepage where it'll say implementing standards, and then on the next slide, once you do that, you'll see implementation issues memo, and you click on that, and these are just screenshots. Then the next slide will show you, basically, there's a whole page, there's a whole page of these memos. So there's only the first two here. There's probably 80 different topics that they've written really good kind of memos and papers and whatnot to help you understand how to apply 606 for very specific, narrow issues. All right, next up is Megan, who's kind of walk you through this from the tax side. So now you know at a high level what's changing from your book perspective. She can help you understand the tax.
Good afternoon, everybody. My name is Megan Anderson, and I'm a Senior Tax Advisory Associate with SingerLewak. I sit in the Irvine office. So I'm here to talk to you about the tax rules related to the implementation of ASC 606. So while there have been changes to the accounting literature and ASC 606, the tax rules on when revenue is recognized are still dependent on satisfaction of the all events test under section 451 of the tax code. So that's for revenue recognition for accrual method taxpayers. So cash method taxpayers recognize income when received. Accrual method taxpayers recognize income when the all events have occurred, which fix the right to receive the income, and the amount can be determined with reasonable accuracy. All the events fix the right to receive the income occurs usually whenever payment is earned through performance, when payment is due to the taxpayer, or when payment is received by the taxpayer, whichever happens earliest. So it's a relatively simple test, sounds like, but as you can imagine, there's going to be a lot of book tax disparities or differences as a result of ASC 606. So the good news is that the Treasury and the IRS have been working together to come up with a revenue procedure whereby taxpayers can elect to follow book for tax purposes. So it'll provide a way for you to easily follow book and go along with book in terms of revenue recognition for tax purposes. So there's quite a few nuances in the revenue procedure, and there's some exceptions as well. And taxpayers still must comply with section 451. So the tax analysis on this issue will require each company to do their own analysis to determine the best course of action to take. There's quite a few figures to take into consideration, which include your industry and your current method of accounting, as well as your tax goals in terms of recognizing revenue. So that was your short and sweet tax presentation. Let us know if you have any questions regarding tax. Thank you.
So, obviously there's a ton to unpack here. We went through it very quickly, and that's why I didn't want you just kind of reading every slide. I wanted you to kind of listen and take notes. The disclosures, there's going to be a ton of work involved there, and what I recommend if you have boards of directors, audit committees, things like that, that's something where I found those types of individuals like to wordsmith everything. So it helps to get a jump start on some of your disclosure wording and circulating it amongst that group just in case they have any feedback or edits they want made. Transition method, again, you saw right there with that illustration how it can make a big difference on what the numbers are in your financials depending on how you decide to do transition. And once you decide that, now you know, okay, is the scope of work going back just to calendar year 2019, or do I need to open up the can and go back to prior years? Because that's what works better for us. And like David was talking about before, this is just GAAP. There is cash basis, there's tax basis, there's other methods of other bases of accounting that are available. So if you want to exit off the GAAP highway because it's just way too much pain and you want to get onto something else, again, that's where you can sit down with us and we can help you understand what's involved with that. It's pretty easy to do, and we can help you, make an informed decision on that.
Jeremy, can I comment on that?
Yeah.
Chances are, most of you are not going to go to the cash method because it's not going to help you financially. You're not going to go to the income tax basis because if you go to that part, you have to do that depreciation. Remember, you're all happy about those big write-offs you got. Can you imagine if your financial statement's got to show the same deduction for depreciation as does your tax return? Chances are you're not going to do that one. There is a financial reporting framework for small and medium-sized companies. That's one that a lot of you should probably be thinking about. What that basically says is what I call it's GAAP with it used to have some other exceptions. Now it's basically down to revenue recognition and some deferred income taxes. Deferred income taxes, minor. But in other words, what it says is we're going to keep on doing it the way we're doing it.
Yeah, think of I call it GAAP light. Think of GAAP the way you understood it back in the 90s, for those of you that old. It's really easy to do, very watered down disclosures. I was part of the group that actually wrote that. And it's very easy basis of accounting to use. With any of these though, I'd say if something, talk to the users of your financials. Make sure they're on board with it before you get too far down that decision path.
You will have to have your bank change all of your loan agreements if you go back to it. If you're in the construction industry and you have bonding, you're going to have to go to your bonding companies and say, is this okay? So my rule of thumb is if you're probably 0 to 10 million in revenues, if you're on QuickBooks, if you're anything like that, chances are you definitely want to go or want to strongly consider this. If you're between 10 to 50 million, you're probably thinking, how adept is my accounting department? How much strength do I have there? And think about it. Chances are, if you're over 50 million, good luck. You're probably going to have to change over to this. And also think about if you have a transaction coming. If any of you are thinking about, it's time for me to cash in the chips, then you have to go and start talking to your investment bankers saying, what's the buyer going to do? Because they're going to want to have everything according to GAAP because that's what they have to do. Now, having said that, I would find the selling is probably about 7 million. You sat out their investment banker, and they said, you know what? Just do it the way you're doing it, and if we have to do it later and go back, we're going to go back and do it. So I have another one thinking about a transaction, 35, 40 million. We're going to talk about that one a little bit more seriously about what has to be done. So again, just some alternatives for you, and some of you may be overwhelmed, but actually I'm thinking several of you in this room, the more, and we hear about this, and even for us, we've been doing this training now for over a year and a half. You pick up more and more. Some of it's going to be not as difficult as what you think, so for that close, you probably want to adapt. Some of you, I was talking to one person over the weekend, said by the time they looked at everything, they probably had 20 different contracts. So you're able to group common contracts into buckets, basically, all right? Well, by the time they figured out what their salesman had promised everybody, there was 20 different buckets with how many variations, and they're in trouble. So this is going to talk about, not only what you're doing now, but how do you make your life simpler going forward.